Hello everyone, Clifford Bennett, Chief Economist at ACY Securities, and welcome to another exciting day on planet Earth. Anything is always possible. Well, we got a bit of a wake-up call yesterday from the Federal Reserve when Fed President Williams said, well, he thinks rates are at about the right level at the moment, but further rates can't ruled out, and interest rate cuts, well, they're just not on the table, and they wouldn't even begin thinking about interest rate cuts till 2024, which means they will probably never happen. And our forecast, which we made over a year ago, or around a year ago, that once the terminal rate was reached, the Fed would be on hold for 6 to 12, and then I changed that to 12 to 18 months, is looking like a very good forecast indeed. What is interesting, though, is that the other Fed President, Matthews, said over the weekend that she felt interest rates needed to go higher, that it could be required to keep inflation in check, that interest rates are actually raised from this holding period. So the Fed is keeping the pressure on, and the Fed wants to do that so it doesn't actually have to raise rates again. The Fed's trying to telegraph to the market, it's Fed speak, that this is a real tightening bias that the Fed is now on pause in. It's on pause, but with a tendency to hike rates if need be, and that is a very real scenario. And we have to look at, a long-term chart of interest rates to again highlight the point I've been making all along, which is that this interest rate hiking cycle where rates have gone to is not an aberration. It's only an aberration if you've only been in markets 4 or 5 years. It's not an aberration. It's a return to normal. Historically, interest rates have been far, far higher than where they are now. And whilst they're about middle of the range here, there is room to the upside for the Fed funds rate to still go higher. And I think that's a very clear risk. My central scenario remains that the Fed will be on hold for 12 to 18 months because the weakening of the global economy is actually going to intensify over the next 6 to 12 months. There may be soft landings about, but there's no refueling of the aircraft for takeoff. So a continued softening of the global economy, continued upward risks for food and energy prices as the conflict in Ukraine rages on tragically. And we've seen movements higher in natural gas, wheat, and oil prices of late that suggest the bottoms of those markets have certainly been seen. And in the case of oil, it's already rallied significantly. And the best that anyone could hope for in terms of lower oil prices is that they stabilize here as a further move down in oil prices for a lasting period is about as likely as a Fed pivot, which I always said was fantasy economics. And again, I say it because, 99% of economists were all going, oh yes, the Fed will pivot like a year ago and be cutting rates aggressively. And of course, I said in real time that was a fantasy, and it's proven to be the case. Oil prices are going to stay where they are or move higher. Fed funds rate is going to stay where it is or move higher. Food prices are certainly going to bounce back a little, and natural gas prices as the Northern Hemisphere, Europe and US, and also, of course, Northern Asia move into winter, there's only going to be upward pressure on energy prices. So, and, even supply out of Russia could be interrupted on occasion, as we've seen. So, oil prices, and there's a lot of Russian oil flowing to the world. It mostly flows to Turkey and then it gets on-sold to Europe and even Ukraine. So Russian oil is still a big part of the world's energy supply. So all of this potential disruption, plus the Fed still being concerned about inflation, I haven't even got to the juiciest bit yet, which is that inflation will tick higher, most likely. We can never be sure because these are just surveys, remember, they're not actual reality. But the survey for inflation coming out this week on Thursday in the US is likely to move up. In fact, it could be 10% higher, as in it was 3% for the annual rate last time, could move as high as 3.3% this week. And within that data, where the real serious concern will be is if that services component and the core inflation number overall is continuing to sustain previous levels. Even if core inflation ticks down 0.1, 0.2%, it's still a very serious worry because it's not come off very much at all from the peak of this inflation cycle. So that core inflation number is staying very extreme. And that is a worry of Fed. And that's why you're seeing this Fed speak about, some saying there needs to be another rate hike still. And most saying it's probably about right where it is, which is what I think. I mean, my own personal view is, and I've said it all along, I've forecast more accurately, I think, than anyone else in the world. I mean, you can compare me to Goldman Sachs, Citibank, HSBC, anyone you like in the world, and I've outperformed on the forecast for the Fed funds rate and what they would be saying and doing. And my view has been that they would hike overly aggressively, and they have. My view has always been there wouldn't be a pivot and that they would then stay on hold for an extended period of time. That's been my view on their actions. My own economic assessment has been that this is a different type of inflation, and the Fed should truly be done in raising rates now, as should the RBA. I don't think either organizations fully understand the nature of this modern economy that's changed so much in the last few years, even let alone the last decade or two. And they don't understand that inflation this time will be a self-defeating process because it's so extreme, it is hammering activity all in its own right. And therefore, you needed to raise rates early and gently, which I said in real time when the whole world, when every other economist and bank in the world was saying that inflation was transitory and they should keep rates near zero. I was saying, no, inflation won't be transitory. And I was saying they need to raise interest rates gently while the economy is strong in that post-COVID boom so they don't have to do a panic aggressive rate hike phase later on. And I said they'd make two big errors in real time, 2 years ago. And that's exactly what's happened. They didn't raise rates when they should have. And then they've raised rates too aggressively and too far when they shouldn't have. Well, because they were chasing their previous mistake, compounding their errors. So my own view is that there should be no more rate hikes. There shouldn't be any rate cuts either, because I don't think we need another asset bubble. And I think interest rates are about right now, both in the US and in Australia. But the Fed itself will maintain this tightening rhetoric and bias. This comes on top of an equity market that's already had a very powerful run. And throughout history, I've always preached that interest rates don't necessarily dictate stock market action. And throughout history, it's a complete false belief that it's a rule of markets that when interest rates go up, stocks go down, or vice versa. Because when I was at Macquarie Bank many years ago, I did a 20-year study that proved that interest rates and stock markets go up together as often as they fall together, because often they're reacting to the same stimuli, an overheating economy or a falling economy. This time it's different because we have a falling economy and overheating inflation, and still too hot inflation. This is why the Fed will keep rates high for forever. I mean, you have to think not for longer. You have to think rates are higher forever, at least the next 15, 20 years. So there could be movements down here and there, but we're not going back to the previous historic crisis levels, even though the economy will be in worse shape than it was in COVID. And we already see that in many aspects of US data. The people who talk about a strong US economy just continue to just crack me up every day. So the US economy is in trouble, cities are being hollowed out, has high inflation, rekindling inflation, it has further inflation risks ahead, it has a central bank that's keeping rates high. There's already incredible interest rate stress throughout the community, from car leases to mortgages on homes to small and medium-sized businesses, business loans, to the regional banks, which are apparently already receiving hundreds of billions of dollars of support to stay open. So the US is in complete disarray. And that will be reflected in the equity market eventually. We've seen a little bit of that of Apple. What happens to a stock that was higher on share buybacks and false expectations? Once reality begins to bite and those share buybacks stop, Apple's down 10% in just a couple of weeks. So Berkshire's just made a spike run, but watch to see if that's sustained more than for 1 week, because there could be some profit taking from some institutions enter the market after that rather significant spike to around about the previous record high and a little bit higher, but only marginally. Should kick on a little bit on the day, but any fallback below yesterday's trading range would be an island reversal and a major historic sell signal for Berkshire. I think they will go sideways and be steady, but just be aware of that chart formation as well. Anyway, I hope all of this has helped. What I'm trying to say is interest rates are going to stay up and the Fed will continue to speak against further equity market rallies. Have a great day. Clifford Bennett. Thank you.